Yo, what's going on, YouTube? So, welcome to my stream for today, where I'm giving you the latest market news from the last time I did this. Um, let me, let's go ahead and begin. Um, so, the last 20 hours or so have been one of those quietly historic stretches in the market. Um, at least that's the sort of signal that we're getting today. Since yesterday afternoon, we've had the US stocks push back upward towards record highs. We've got the dollar sliding towards a 4-year low, and at that same time, the gold is actually holding above $5,000 an ounce, and silver is still within the triple digits. Let's actually just check the price of silver real quick. Still floating around that $107 range. It seems to be a main level of consolidation, at least for now. And, but yeah, still over that $100 range. And that's even after some profit taking this morning, apparently, from some news articles. Uh, so this mix of stocks near record highs, the dollar getting absolutely wrecked, and then the monetary metals doing very well. It's not exactly normal, but that's the world basically saying where it thinks the value is actually going over the next decade. For the everyday people, what this means is actually quite simple. The dollar that is in your bank account is quietly becoming worth less and less, or at least its purchasing power. And the assets that are tied to productivity and hard value are getting a bit more expensive to purchase and are becoming more valuable. The gap between the people who own things and the people who only hold cash is widening literally by the day at this point. And for my website, this is a straight up bullish signal. My website, soulshotsilver.xyz. It's an entire thesis essentially that is stating that if the dollar keeps bleeding out and the metals are grinding higher than ever before, then having a smooth way to turn on that on-chain activity and turn that into a precious metal is a very useful thing to have and will be beneficial in the future. It's essentially a lifeline, and that's actually why I built it, to be honest. So, on the global power side, a weak dollar with record gold says that the entire rest of the world is trying to test how far they can push away from the US monetary dominance without actually breaking the system. Now, here's what the next slide is saying here. AI expansion. So let's touch on that for just a moment. So here's when things get interesting on the equity side. Actually, let me see if I'm on the right slide. I'm on the right slide. I believe so. Let me actually just make sure. Getting these slides created is probably the most difficult thing when it comes to these live streams. Yeah, I think I'm on the right slide. So here we go. The big reason that stocks are this strong currently is actually due to the earnings, especially in the U.S. tech department. The futures on the S&P and NASDAQ have been pointing to much higher prices this morning, and with the market basically betting that the mega caps are going to keep delivering those monster profits even while everything around them is feeling quite shaky. Underneath all of that, though, there's been a lot of those earnings. That earnings story is just being juiced up by a huge underreported surge in corporate debt. The big tech has issued over $100 billion in new bonds recently to feed the entire AI revolution. This is building out even more data centers, and also the power infrastructure like never before. And this is, I believe, also to compete with China because their power infrastructure is quite compatible with what the future looks like. For regular people, this means that our index funds are riding on companies that are levering up to chase the AI trend. And if those AI bets don't um, go the way that Wall Street hopes, um, that leveraged that leverage actually comes back as volatility in the retirement accounts. For my website, I would actually call that a neutral to bullish scenario because my business doesn't necessarily depend on one big tech narrative paying off, other than Solana and blockchain technology. Um, so we just need the trading volume, the speculation, and the reward cycles. Is that really? I believe I might need to mess with these research notes again. So for my website, really all I need is customers. I have zero customers. If I were to say, that's my first hurdle is getting my first customer, whether they're writing books, um, whether they're using the non-custodial trading bot, or even a mentorship session. Just having people that I can mentor and help understand um, my framework, and the way that my mind works. Um, but anyways, from a global power perspective, the whole AI revolution is actually funded by a lot of debt, and it's like building a new empire on top of a credit card. Um, and that's sort of where we're at. And it's impressive now, but if the interest costs are going to spike or the growth is slowing, then the bills become a geopolitical story and not necessarily just an earnings miss anymore. If we move into the bonds and interest rates, let's move here. All right. So the bonds and interest rates, because that's also plumbing, the entire plumbing underneath everything. So the start of 2026 has been very bumpy uh, start for this year, especially for government bonds and bond yields. Um, the yields in the more developed markets have been jumping around more and more as the traders are constantly trying to reprice what these central banks are actually going to do this year. We're heading into a Fed meeting where the base case is no change on the rates, but what really matters is the tone. Do they lean into higher for longer because inflation is very sticky, or do they start to hint at cuts because growth is starting to wobble and slow down? For the everyday people, what this shows up as is 1 week mortgages look a bit cheaper. Um, what this shows up as, um, 1 week the mortgages look a bit cheaper, but the next week the mortgages might rise again in the price. And also your car loan rates don't necessarily come down either. The bond market, the bond funds in your 401k that were technically safe are feeling weirdly more unstable. And the managed futures and trend following funds are actually loving this entire environment because they're literally surfing these big moves in stocks, bonds, and currencies, and also commodities from what we can see in the silver and gold prices. But they're designed to pick up signals when the world is shifting under the surface. So that's why the managed futures and the trend following funds are loving this environment. From my website, my business, the choppy bonds are quietly building up bullish momentum because mainly if people are losing faith that owning government IOUs preserve their wealth, then they can go looking for more alternative stores of value like metals, which will ultimately maybe drive people to my website, my business at some point. The crypto rails, or even some combo of both, you know, earning uh, while on chain might be a very popular thing in the future. So, from a global power perspective angle, the entire unstable bond markets are more like a stress test on who's really in charge right now. The governments are issuing the debt, or the markets are deciding how much they're willing to get paid to hold on to that debt, rather, right now. If we talk, so let's move on to our next segment here, which is the fact that the dollar is weakening and that this is changing quite a bit. Um, so, because of the greenback's behavior, the US dollar, in this window, it is a very big tell. Over the last day, we've actually watched the dollar go towards its weakest levels in almost 4 years, which is a very big signal. And as the investors are rotating into more risk assets and commodities, a weaker dollar makes the US exports a bit more competitive. But it also means that imported stuff like energy, electronics, and a lot of the food that we're importing are also getting more expensive over time. For someone who's just giving, or who's just living out their life, this shows up as like why are groceries and gadgets still going up, even though everyone says that inflation is coming down. And that's exactly why, is because of the exports and imports, and the value of the dollar. For my business, a weakening dollar is practically an advertisement. If the unit amount that you get paid in is losing its purchasing power against gold and silver, then stacking ounces through a hybrid system that taps into some sort of crypto rewards are suddenly looking more like common sense rather than a fringe idea. On the global power side, a soft dollar plus record gold is the classic de-dollarization signal. Foreign central banks and also sovereign funds are quietly saying that we still use the dollar, but we don't trust them as much. And so, what we're going to do is own more metal and more diversified assets. So, yeah, this tells us that they're hedging against market instability. The currency war here isn't necessarily tanks and planes, it's just basis points and bullion. I mean, that's really all it is. And if we shift to the next segment here, which is the India EU trade, let's talk about that for a minute. So, one of the biggest structural headlines in the past 24 hours has been the India to EU trade deal that they're literally calling the mother of all deals. India and the European Union just finalized a free trade agreement that literally cuts or eliminates the tariffs on over 96% of any goods by value from the EU side, and more than 99% over time from the Indian side. So this is very bearish news, I would say, for the United States. If other parts of the world are willing to work together and instead of just rely solely on the United States, that's very bearish for the U.S. And um, so vehicles that used to face um, triple-digit tariffs, transportation, in India are going to see those um, duties slashed over the next 5 years. The high-end alcohol and industrial goods are getting much more cheaper to move in that region, and the Indian exports from textiles to chemicals and also to gems are getting much more smoother access into European markets. for the everyday people, this matters also because it reshapes where the jobs are, where the factories are, and also where the supply chains are sitting. Some things might get cheaper in Europe, and some of the Indian sectors might see a bit of a boom. And it further reduces how much the world has to necessarily rely, like I was just saying, on the US and China access for trade. And so for my website and my business, I would say this is actually a long-term bullish trend, because what this means is more trade between big non-US blocks. It just means more cross-border consumption. And this just means more currency risks and more people who want to hedge against that risk with something that isn't necessarily tied to one government's promise, like much like silver is not. On one power front, I would say this is actually a very massive move for India and the EU, the European Union, because they're basically saying that we can build our own trade superhighway and rely a bit less on the US and China. And in the currency war terms, that's just another chip off the dollar's monopoly on global commerce. So yeah, that aligns with what I've been saying just a minute ago. Um, so let's talk about how the markets are reacting globally to this whole reshaping. So how did the markets in India necessarily react to the fact that the trade bombshell while you and I were sleeping? Um, I mean, unless you're a night owl, you know, you might have been awake during those times, but the Indian equities have been whipsawing, from what it's saying here. The recent sessions saw Nifty and Sensex down nearly 1% as traders are have wrestled with tariff headlines. But the fresh news of the final deal has sparked rallies where the benchmark indexes are pushing higher yet again. You can picture it like this. So the local investors are trying to price in real time what happens when your country plugs more deeply into European demand, but also faces more competition at home. So normal people in India, for the normal people inside of India, what this can mean is that more job opportunities in export oriented sectors might also, but I'm sorry, let me back up there for a moment. So this could mean more job opportunities in the export oriented sectors, but also more pressure on these small domestic producers who have suddenly have to compete with the new European brands on their own turf. From my website, this is kind of exciting from what it says here, because a rising middle class that's more connected to global trade is exactly the type of profile of a future consumer who thinks, hey, I've got a Solana wallet and I've got some crypto rewards. Maybe I siphon a bit into some real silver instead of just holding some rupees or euros. And from the power lens, India is tying up with the European Union on trade is like watching a new alliance form in the global game. And yeah, I would very much so agree with that. It's saying that it's not about one day's stock move over another, but it's about who gets to write the rules for the next decade of commerce. And that's what you can see is global repricing and restructuring, somewhat to a degree. So if we come back to the shiny stuff like gold and silver, um, they deserve their own chapter for today because gold has punched through that psychological level of $5,000. Let me actually take a look at gold really quick. So it's almost at 5,100 right now, and it did go past 5,100, um, but that's where we're at. It's holding that level, it seems like. And yeah, it's holding near there. While silver, which cleared $117 yesterday, is giving a bit of uh, a downtrend. It's coming down a little bit. It's although it's holding around that. Well, now it's 106.24, 106.13, 106. Yeah, it's coming down a little bit. You know, but it's consolidated around that mid 110 range essentially. Um, so this language that we're seeing basically from the metals is saying that there's a frenzy and a stampede. People are rushing into the trade because it's finally broke out of that old range and they don't want to miss. They're basically fear of missing out, FOMO. A lot of the crypto traders used to feel that back in the bull runs, and it's weird saying it like that because it feels like it's been so long. Um, but for the everyday people, it's important to understand what this all really means. Um, it's not just the speculators chasing the charts anymore. It's a bunch of central banks, institutional demand, all piling into a limited supply of metal. And what ultimately happens is the price just doesn't go up. It jumps in chunks and it stays there for who knows how long. Um, it's leaving the latecomers behind with very tough decisions to buy at higher prices or wait for that stuff to come back down. For my website and my business, this is basically textbook bullish. My entire model is to um, hold a certain amount of silver and to help people turn their digital cash into fast, uh, sometimes get speculative gains, into silver. And when silver's flying like this, the trade can feel very emotional. Um, so right now, okay. So I want to start right here by saying that um, nothing in this video is like financial advice. I can't tell people what to do with their money. I'm not in a position to do that. But what I will say is that in my mind, the way I've calculated my business model, I would not recommend somebody to purchase silver right now. The prices being this high necessarily aren't actually that great of a thing for the price of silver or businesses and industrial demand that deals with the price of silver. Um, Lower prices are generally favorable, but based on basic supply and demand, silver's prices might get pushed up towards the upside not too long after some sort of consolidation, especially if gold is still pushing past $5,000. That's just going to make sort of this whole domino effect happen, faster. And on the global power perspective side, if gold is still over that whole $5,000 and the central bank demand is overwhelming that supply, then it is literally the scoreboard of nations saying, we trust metal more than the promises right now. And that is a very big statement about the entire direction of the entire monetary system. Um, so here's where things get a bit more interesting. Okay, so I just went over that one. So let's talk about Bitcoin for a minute. All right, so Bitcoin right now is basically stuck in traffic, essentially. Um, it used to be that Bitcoin reacted very well to the traditional financial system, but now that you've seen sort of precious metals take off and policies being enacted, and general geopolitical changes, this is affecting even the price of Bitcoin very significantly. We might not be seeing um, the effect that this has on Bitcoin is that we might not be seeing um, as large of bull markets as we have seen in the past. And this is simply because of the way Bitcoin was designed, um, or has been adopted by the major corporations and stuff. And over the last day, Bitcoin has been hovering around the $88,000 mark, but it is falling through around. It says it's failing to punch through that big $90,000 range, and overall, it's down just a few percentage on the week. So even while the gold is ripping to new all-time highs and the stocks are climbing, um, and the ether is drifted down towards a support loan zone, and other majors like XRP and Solana are mostly following the same pattern versus the dollar. It's a small green move here and there, but nothing like the whole breakout that we've seen in the past, or like we're seeing now in metals. For regular holders, this feels kind of weird because the assets that were supposed to be the whole digital gold thing is not acting gold like gold at all. And it's acting more like a tired tech stock waiting on the Fed. For my business, I actually see this as a very bullish outlook because of our hybrid thesis. If Bitcoin alone isn't giving you that whole I'm hedged feeling anymore, then you can then you combine that on-chain rewards and Solana speed with real silver backing. That's what my website offers, in a way to get the best of both worlds instead of betting everything on just one orange coin, and for the global power perspective here, because this is sort of important for where we're going. Bitcoin stalling while the gold soars says that nation states are still voting for the oldest collateral in the world, even as individuals are experimenting with the newest collateral, Bitcoin. Um, so if we move on to the next one here, let's talk about Solana for a minute. Okay, because it actually matters a lot for how my business, soulshotsilver.xyz, is actually functions from the day to day. In today's action, or the last 24 hours, Solana is one of the better performing majors. Again, up around 1% and trading in that low hundreds zone, roughly the 120s area, while a lot of the other altcoins are just chopping sideways. That tells us that even in the market where Bitcoin is an indecisive play, that there's still a strong bid for very fast, low fee infrastructure like Solana that can actually run consumer facing stuff at a scale. So for the everyday users, this means that apps built on Solana, like my website, Soulshot Silver, stay very cheap and responsive, which is the difference between, hey, this is fun to use, and the fees are eating my lunch. For my website, my business, that's pure operational bullishness. Our reward loops and our token flows are all the little micro transactions that happen when someone is DCAing into silver through the system, or they become economically viable in a way that just wouldn't be on a slower, more expensive chain. So just to kind of put that into perspective, it's saying that when you use my platform, the fees are not going to eat your lunch for you. Um, and even if you try to use its other features, like creating a book or applying for a mentorship session or using the trading bot, it's all extremely affordable through the Solana blockchain. Um, but on the global power side, a chain like Solana is literally winning market share, and it's also about which tech stocks end up powering the next generation of the whole financial plumbing system. And whichever wins becomes a quiet piece of the monetary infrastructure that governments are eventually having to reckon with. Um, so if we move on from there, so here's something that a lot of people don't necessarily connect directly to the markets, but it absolutely could or should. And the prediction markets are the way they're trading Bitcoin right now. You've got platforms literally running their own markets on whether Bitcoin will be up or down in a 15-minute window or what its price will be at a specific hour today. And that tight exact probability bands around that 78 to 80,000 type range are in some of those contracts. Um, so what this tells us is that we have a lot of the action in the short term, leveraged and hyper speculative section where people are trying to guess how a 5 minute candle prints instead of thinking in a multi-year fashion. Now, for the average day people, the big takeaway here is very simple. If you get sucked into that whole world, if you're not investing anymore and you're just gambling against the pros who are staring at order books all day, for my business, this is literally the opportunity that I can sit on top of that speculative energy and just say, okay, cool. You want to trade and take risks? Do it on my non-custodial trading bot. Um, but every time you do it, we'll make it super easy and simple for you to peel off a bit of that into actual silver before the markets are going to eventually take it back. From a power perspective, these prediction markets are just kind of a way to shadow vote on the sentiment itself. They're showing us how the confident or the nervous people are about more about these short-term moves, but they also remind us that the real power shift is happening in the big structural charts, like the debts that are going on, the bonds, the trades, and also the metals. Um, and it's not just in a 15-minute candle anymore. Right now, let's talk about an elephant in the room because the national debt itself is becoming the slow moving monster behind almost every single macro chart that we're looking at right now today. As of this month, the gross national debt is sitting around 38.4 trillion, and it's been growing at a pace of over $8 billion a day. And at the current trajectory, the credible estimates are saying that we're on a path towards something like 48 plus trillion dollars by 2030, which is an almost cartoonish number when you say it out loud. Um, and when you actually can put that into a perspective. But for an everyday worker, this doesn't show up as a big red number on a website. It shows up as a higher future tax in their literal paycheck, and higher inflation risk, and also a government that has less room to respond to the next crisis because of so much of the budget has already been spoken for by the interest payments. Um, Let me make sure that I'm on the right section. I believe this is the one I should be on. Okay. So for my business, this is actually fundamentally bullish. My entire pitch is that you don't leave your future entirely in the hands of people who are clearly not managing their balance sheets correctly. And the more that the debt clock is spinning, and the more that people are feeling that in their gut also, um, the more that you're going to have people that are thinking that. Don't leave your future entirely in the hands of people who are not managing the balance sheets accordingly. And from a global power perspective standpoint, a debt path like what we're seeing is how empires actually drift from unquestioned to still powerful, but also negotiable. And when the creditors start quietly trying to diversify into gold and silver, and also more alternative rails like Solana and Bitcoin, that's the market also expressing doubt about how the long-term U.S. fiscal stewardship is being played out. Now let's move on to the foreign nations and how they are quietly reducing exposure to the U.S. debts. So here's the twist. So it's not just the households that are rethinking the treasuries, it's actually even the small countries where making symbolic moves that tell you, hey, the world is reconsidering how much of the US debt that they're willing to hold. Denmark, for example, more recently has trimmed its treasury holdings down under $10 billion. And you've got European institutions that are also openly talking about whether they should keep financing the US deficits at even the same scale. Because, especially after the whole tensions, like I was just saying more recently with Greenland, and that whole episode flare up, it's at the same time, the Europe has a block holds of trillions technically in the US assets, which means if they ever decide to seriously lighten up, that becomes a real pressure point on the Washington Financial Institute. For the everyday Americans, this is the very invisible um, like rug pull until it isn't. Um, if the foreign buyers are getting less enthusiastic about the treasuries, then that can just mean that higher interest rates are more down the line, or more money is actually being printed to plug that gap. Both of which are hitting our cost of living here in the United States. For my business, that basically the more global capital that tiptoes away from the U.S. paper, the more compelling it might be to hold wealth in something that doesn't necessarily care on which government is in charge. And for silver, from the power lens, this is the classic capital markets geopolitical move, that no one has to declare anything. And all they have to do is just shift their portfolios to a few percentage points at a time. And over the years, that quietly changes who actually holds the leverage. So there's that to kind of worry about. Let's move on. So so now here's another twist. Um, we're actually hold on. Let's circle back to the Fed here. I was starting to read the other one again. So because everything that we just talked about, which are the stocks at record highs, gold ripping, Bitcoin has been stalling, and the dollar's been sliding, and the debt's exploding. This all funnels also into how the markets are front running this week's meeting. The traders are basically assuming that the Fed holds rates steady, but there's a big there's a big debate whether over the guidance. Um, do they hint at cuts later this year to keep the party going, or do they stay tough on the inflation, even if that means the risk assets are going to um, kind of weeble and wobble? for the normal people, it boils down to this: does my credit card APR ever come down, or do mortgage rates get a bit more reasonable, or are we just literally stuck here while the rent and food keep marching higher than ever before? So my business, uh, so for my business, both of these outcomes have a path to bullishness. So if the Fed stays tight and the things are starting to break, that's good news for metals and also hedges. If they pivot and start easing up, that's a great news for risk assets and also trading activity, which feeds into our on-chain reward loops. From the global power perspective, right now, every Fed meeting is kind of like a global referendum because so much of the world's debt is dollar linked. When they move or even hint at a move, it affects every single government and even the corporate bonds and every currency pair. So let's move on to the next one here. So governments everywhere are being strained financially. So here's the story that ties into real life. The way that inflation and borrowing costs are squeezing governments outside the US, like the United Kingdom's situation. We've seen recently in Britain, you've got government borrowing still historically high, debt hovering around the mid 90s% of GDP, and a big chunk of every pound of spending is just going to the interest payments. And that's the same underlying math that's playing out in different ways all over the developed world. So high legacy debt is one of them. Aging populations, social promises that are very hard to walk back, and also for everyday citizens, this means more in taxes, more stealth austerity, and more inflation. Some combination of you pay more but you get less. And even if the headlines never say that directly, from my website, my business, this is a very background sort of bullishness. The more people that feel the government promises are not holding up, the more they're open to taking a slice of their savings into something that they themselves can self custody. But whether that be a Solana wallet or a tube of silver rounds, from a power lens, heavily indebted governments are much less flexible. It's less about the project power and more about the whole likely to lean on financial repression, holding rates below the inflation, and also to make the math kind of work, which again rewards anyone sitting in scarce assets. So there's that. So let's get practical here for a minute. Let's talk about what all of this actually means for the average person who's stacking versus speculating decisions right now. If you look at the scoreboard, the stocks near record highs, tech-driven AI debt, the gold and silver just going absolutely vertical, and Bitcoin being stuck under a key psychological level, and that the dollar is also sliding. What that says to this research here is that the market is saying own things tied to real value, but don't forget that liquidity and spread and speed also matter. So for someone who's just trying to build a resilient business model, that probably looks like a base of hard assets like silver and gold, some allocation into product productive equities, and then even a smaller, more deliberate allocation to on chain assets that can move fast when narratives are flipping. So, for my business, this is the exact sort of niche that we're trying to occupy. We're not asking people to pick a team in crypto or even a team in metal. We're just saying use crypto to earn, move, and get rewarded, and then convert that part of the flow into something physical, like silver or gold, so that your future doesn't depend on just one chart alone. From a global power perspective, the people who do the best in this kind of environment are the ones who are thinking like small sovereigns, diversified reserves, multiple rails, and a mix of digital agility and physical backing, all of which my website, soulshotsilver.xyz, offers. Um, we're coming towards the end of the research for today. But now here's a subtle but also important theme from the last day, which is the rise of systematic strategies. Things like managed futures funds and also quant models are quiet power players in this future environment. These strategies don't necessarily care about the headlines in the emotional way that we used to. They just react to the price, the volatility, and the statistical patterns across the stocks, bonds, and commodities and currencies. When you've got gold breaking out and the dollar sliding, and bonds are getting whiplashed around, and stocks are also going higher, then these systems can pull billions of dollars across markets in the same way that amplifies moves in stuff like Bitcoin. So for regular people, this matters because your simple ETF fund might be on the other side of the trades, which are driven by algorithms that are technically faster, more disciplined, and also way less emotional than you would ever be. For my business, systematic flows that are actually an advantage, more trendiness and volatility means more trading volume, which is more realized P&L for its active traders and more opportunities for the traders on my platform to catch some of that and also convert it into silver for people who are not necessarily wanting to ride every single wave. Um, on the power front, it's a reminder that not all of the power is indeed political, but some of it is embedded indeed into the code and also the models that are quietly deciding which assets are in favor and which governments can borrow effectively and cheaply. All right, so let's move on here. I'm actually going to grab a drink real quick. So what's going on, YouTube? All right, let's turn this back to the commodity. Let's turn this back to commodities that are beyond just the gold and silver, because there's another layer of this entire story that matters for the next few years. Stuff like copper and the infrastructure metals, alongside the gold and silver mania, the analysts are warning about the looming copper shortages driven by things like AI data center build outs and also electronic vehicles and also the electrification push. Um, this entire narrative is very important because copper is like the wiring of the modern economy, um, especially if it gets structurally short. That's inflationary in a way that's very hard to fix, in a sense, with just interest rates alone. And for the everyday person, this can translate into higher prices for anything that plugs in or moves people around, like cars, electronics, um, housing, electricity, building. My electric wheelchair, for another instance, might become more expensive. You name it, anything electronics. And for my business, that broader commodity squeeze reinforces the entire idea that scarcity is not just a Bitcoin meme. It's a real world constraint that you can feel in your cost of living, which makes owning something scarce, like a monetary metal, a much more natural part of a normal person's portfolio. And from a power lens perspective in the global economy, whoever controls that supply and the processing of these key metals like copper, nickel, and rare earths, which I think might be China, gets actually leverage in negotiations. And that has really nothing to do with the aircraft carriers and everything to do with, do you want your grid and your AI to keep working? Um, so yeah, there's that. So let's move on to the second to last uh, section here. So here's one more thread to pull on. The way that big AI buildouts and also sovereign debt both depend on the same capital markets. It's also how that intersection can go very sideways. Big tech is issuing record amounts of bonds in order to build out its data centers and also the energy infrastructure. So while governments are issuing record debt in order to roll over the old obligations and also pay for social promises, both of them are fighting for buyers in a world that is getting more cautious about the long term durations and risks. For the everyday people, that exact tug of war is showing up as a sort of, why does it feel like everything important is underfunded, but also everyone is borrowing insane amounts of money? For my website, my business model, this entire convergence is literally a gift. Uh, so, as more value lives in the data and the algorithms, the need for something outside of that system, like physical metal in your custody, is actually growing more and more. Because you don't want 100% of your future tied to how smoothly the AI debt machine, as well as the government debt machine, can keep rolling. From the global power lens, if the capital ever decides to want to fund both at scale, um, anymore, if it does not want to fund both at scale anymore, then we could see a repricing in either the sovereign bonds or the tech valuations that would make this current calm look uh, more like the warm up act. So let me go down to the last one for today. All right, so let's bring it home and talk about how um, what we might actually want to be doing with all of this um, in my website business's context, um, because it's kind of the same mental model. We're in a world where gold is above 5 grand and silver is over $100. Um, the United States debt clock is indeed spinning like a slot machine, and the dollar is sliding to multi-year lows. Stocks are near record highs, and Bitcoin, while still a financial beast, is still suddenly not the only or even the main hedge trade that capital is crowding into. For an everyday saver, the simplest way to think about this is you don't have to predict the exact path. You just have to stop being so nakedly exposed to one outcome. So that's what we're building with my website. Users are able to create books, purchase silver, get mentorships, um, help people understand um, where the world is going and where they could be going with their future as well. And that's what I'm building on my website, is a way for people to plug into on-chain activity, like on Solana, and earn value over time with a high speed and low throughput cost, which is the Solana blockchain. But then also be able to redeem those exact flows of tokens into things like physical silver or discounts for physical silver, um, and that lives inside of the real world and doesn't necessarily depend on any single one government, company, or even a protocol. From a business lens, everything that we've just like walked through, from the India EU deal to the Fed to the debt clock and the gold spike, it's either bullish or at worst neutral for my business model. Almost nothing about today is structurally bearish for the fusion of digital asset rails and the physical scarcity of something like silver to be combined together. And from a global power perspective, I'll leave this off with the direction of travel is very clear. More fragmentation is happening, more currency competitions, and also more commodity leverage is higher than ever before. And also, more people are trying to quietly opt into systems that give them a bit more control over their future instead of outsourcing it to something like Wall Street or Washington. And if you enjoyed today's breakdown and stream, please make sure to like the video. It would be super helpful if you subscribe to the channel. Check out my website. I've spent a lot of time, energy, effort, and money building it. It's www.soulshotsilver.xyz. It's in the link in the description. Check out my Discord. Roll a hardcore WoW tune over on Alliance Doomhowl and join the WoW Guild. It really helps me out. Anyway.